Hey, welcome back. Today we're going to be talking about the basics of mortgage and what that entails. Before we do that though, please do me a favor, click that subscribe button and let's get started. So to start things out, let's simplify everything and start from the very beginning. Let's answer the question of what a mortgage is. A mortgage is a loan that you take out to make payment on the house. You take that from a bank and then you make the payments to the bank. But what that allows you to do is not have to front hundreds of thousands of dollars just to buy a house. You can choose to pay that loan off over the course of 8 to 30 years, sometimes even 40 years. Now, a lot of people think that the first thing that you should do is start looking online or talk to a realtor about what house they want to buy and kind of start window shopping. But in reality, what you should really do is talk to somebody that's in the mortgage business, which is either a mortgage loan officer or a mortgage broker, such as myself. That way you can find out how much exactly you can get pre-approved for, and what you want is a pre-approval. Now, you might have heard about the term pre-qualification or pre-approval. What's the difference, Fred? So a pre-qualification and a pre-approval are definitely different. A pre-qualification is just me and you hopping on the phone together. We'll chat about your current situation as far as what you think your credit score is, what your finances are, how much you make, what kind of debt you have, but I don't actually pull your credit. So I'm just taking your word for it. A pre-approval is a lot stronger because I actually pull your credit, or any other lender will pull your credit. They'll look at your income as far as pay stubs, W-2s, and they'll also look at your bank statements to make sure that you have the proof of funds for a down payment and closing costs. Now, the biggest misconception is that you have to put 20% down on a house, which couldn't be further from the truth. And let's face it, putting 20% down on a $300,000, $400,000, $500,000, $600,000 house is sometimes impossible, especially with the way inflation is right now. The cost of eggs is going up. It's crazy. What not a lot of people know is that you can actually get into a house with as little as 0% down in some instances with a down payment assistance program. But I would say a good rule of thumb of how much money you should have saved up for a down payment is anywhere from 3 to 5%. I say this because you want to also think about the closing costs that will be associated with the loan. So a down payment is not the only thing that you have to think about when it comes to purchasing a house. You also need to think about closing costs. Depending on where you are, that runs anywhere from 2 to 3% on top of the down payment. Now, you may be wondering what the difference between a down payment and closing costs are, which is a great question. A down payment goes directly towards the value of the house, so it brings that loan balance down. Closing costs are what it costs to do the loan and also to set up your escrow account, pay for title, things like that. And that's why you want to have a little bit extra saved up. So you're pre-approved. Now what? With the pre-approval, you actually get that over to your realtor, or a good lender will send that to them and keep an open line of communication. This is where the fun starts. You can actually start looking at homes that you know you'll be pre-approved for, that you can confidently put an offer down. And with that, let's say you do fall in love with a house, you can bring an offer. And let's just say you do put an offer in and the offer is accepted. From there, you open up what's called an escrow, which typically lasts anywhere from 30 to 45 days, depending on what the terms are. The first step that you're going to do is put your earnest money deposit down. That's usually about 1%. It varies. And in some states like Texas, you put down what's called an option fee, which gives you about a week to make sure that the inspections are done, whatever inspections you want to do, and make sure the house is in good standing condition. If it's not, you can back out. Now, once your offer is accepted, that's where the hard work starts for both you and the lender, but don't get freaked out about it. The first step is to order the appraisal. We want to make sure the house is going to appraise and it's good to go. And then immediately after, you're going to get into what's called underwriting. Underwriting is just the lender looking into the nitty-gritty details as far as your income, make sure you're still employed, your assets are still there, and you don't have any crazy deposits or withdrawals going, which I want to get into this too. Here are some don't do's while you are in underwriting, or even before you get into a purchase contract. So rule number 1 is obviously don't quit your job, or if you're going to move jobs, keep it in the same field. That's totally fine. Rule number 2, do not, I repeat, do not, from the point that you apply for the mortgage for a pre-approval to the point of the house closing and you getting your keys, don't make any big purchases. There's been so many times where clients, they're approved or they're just squeaking by, and then they decide to, open up a new credit card for a furniture store because they're so excited about getting new furniture in the house. Save that for later. Trust me, because if you do that, your credit score will go down. Your what's called debt to income ratio will also increase, And that can increase your payments, your interest rate, or just plain out not be approved anymore. Okay, now we're through underwriting, we get what's called a conditional approval. What that means is that there are some conditions to clear. Conditions are minor things like, hey, let's just make sure that so and so has been in this role for so and so amount of time. Or, hey, why is their income fluctuating a little bit? Or, hey, what was the previous experience before this job? But if you have a good mortgage loan officer or a mortgage broker, they will do a lot of that up front so that there's not as much back and forth during the process, making life a little bit easier for you. Because let's face it, mortgages are a little bit complicated and stressful. So during the process, after conditional approval, you may be asked to submit some extra documents, some updated pay stubs, some updated bank statements, but that will get us through to what's called a final underwriting and eventually a clear to close. Once again, what a clear to close is, you are clear to close. You don't need to do anything else. As long as the house doesn't blow up, nothing happens, you're completely fine to move forward. After you're clear to close, you will go ahead and sign at the title company or the escrow company. These are the final documents. You're going to wet sign them in person. Wet signatures means that you actually put them on paper, not DocuSign. And from there, the loan funds and you get your keys.